Oil is surging, silver is crashing. And if you think those two facts are connected the way the mainstream media is telling you, you're missing the most important market intelligence story of 2026. I've been tracking this anomaly for 27 days. What I found is documented, primary source confirmed, and deeply uncomfortable for anyone who trusts the official narrative. Let me give you the setup. WTI crude just surged 4.6% to $94.48. Iran rejected the peace talks Trump announced on Monday. The 5-day diplomatic window closed with no framework. Brent crude is climbing back toward $100. The IEA just confirmed the largest oil supply disruption in the history of the global market. The Strait of Hormuz is effectively closed. And silver is sitting at $68.20, down 44% from its all-time high. That is the anomaly, and I'm going to hunt it to its source. My name is Marcus Caldwell. I'm an independent market analyst. And this channel reads primary sources, the IEA Oil Market Report, the SMM Shanghai Metals Market Weekly Review, Financial Times Investigations, CFTC data. No speculation, no noise. Verifiable intelligence only. Drop this in the comments right now. What anomaly have you personally noticed in the silver market recently? One sentence. Your observation matters. This community's collective intelligence is more powerful than any single analyst. Before I reveal the 3 specific anomalies I've documented, if this kind of market intelligence is valuable to you, hit subscribe and turn on notifications. This channel exists to give you the insights institutions don't want retail investors to have. Your subscription directly supports independent financial analysis. Now let's examine what the smart money is actually doing right now. Anomaly 1. The trade that happened 15 minutes too early. A Financial Times investigation identified a specific, time-stamped, documented trade. $580 million in bets on falling oil prices. Placed 15 minutes before Trump published his statement on postponing Iran strikes. That statement caused oil prices to fall. Whoever placed that trade knew something before the public did. Now, does this directly involve silver? Maybe not. But here's why it matters to every silver investor. That $580 million pre-position documents a specific type of information asymmetry. Large capital entities positioning ahead of public market-moving catalysts. That same information asymmetry, large capital moving ahead of retail, is operating in the silver market right now. And the pattern is identical. Anomaly 2. China importing silver at a multi-year high during the crash. This one is confirmed by Shanghai Metals Market, the most authoritative institutional data service for Chinese commodity markets. In February 2026, China's silver ingot imports hit their highest level in multiple years. February was the month silver dropped from $85 to $65 on its way to the $60 crash. Read that again. China's imports hit a multi-year high at the exact moment the Western paper market was collapsing. The official explanation says oil up means dollar up means silver down. China apparently disagrees, because China is buying discounted paper silver with real money at record import volumes. Two markets, same metal, opposite conclusions. The Western paper market is pricing silver as if inflation fears are the dominant story. The Chinese physical market is pricing silver as if this crash is a strategic accumulation opportunity. One of them is wrong. The historical record of 2008, 2011, 2020 is clear on which market eventually wins. Anomaly 3. Industrial demand that won't respond to price. This is what fundamentally breaks the official narrative. If silver were a normal commodity with elastic demand, the drop to $68 would trigger a surge in industrial buying. More buying would tighten physical supply. Tighter supply would push paper prices back up from the physical side. That is not happening. AI data centers, 5G networks, electric vehicles, high-performance GPU power systems. These buyers are drawing from shrinking above-ground stocks at $68 at the same volume they were drawing at $94 on March 2nd. Price inelastic demand. 6 consecutive years of structural deficit. a projected shortfall of 67 million ounces in 2026. And oil making every silver mine on Earth more expensive to operate because every silver mine runs on diesel. Industrial demand makes up 59% of total silver consumption. Those buyers don't care what the COMEX screen says, they need silver. They're taking it at whatever price the paper market prints. Here's the full honest counter-argument, because this channel gives you both sides. The official position says the oil dollar mechanism is clean and logical. Oil rises, dollar strengthens, silver falls mechanically through the inverse correlation. Managed money net, longs dropped from 44,000 contracts in Q2 2025 to approximately 21,000 in March 2026. The momentum tourists who bought silver during the bull run are leaving. The pain may not be over. That argument is real. The DXY inverse correlation is real. The tourist departure is real and confirmed by CFTC positioning data. But here's the critical asymmetry the counter-argument cannot resolve. The dollar strength mechanism that is suppressing silver's paper price is short-term. It deflates when the war premium fades or when the Fed eventually pivots. The cost increase flowing through diesel prices into mine operating costs is medium-term. It compounds over quarters, not days. The paper market is running a sprint. The physical market is running a marathon. And in every prior silver cycle, the marathon won. JP Morgan forecasts an $81 average for 2026. Bank of America targets $135. Citigroup maintains a bullish second-half target of $110, contingent on the Fed pivot. The question has never been whether silver recovers. The structural thesis is intact. 6-year deficit, inelastic industrial demand, rising production costs, China accumulating at multi-year high rates. The question is how much pain comes before it does. And right now, with oil at $94 and climbing, with Iran rejecting peace talks, with 0 Fed cuts priced for 2026, and with the DXY holding above 99, the pain is real, documented, and sitting at $68.20 on the COMEX screen. Here is what I'm watching and what you should watch. Watch the PCE data at bls.gov. That number determines whether the Fed's hawkish posture is sustainable or whether the oil shock itself eventually reverses through demand destruction. Watch the CFTC commitment of Traders Report at cftc.gov, published at 3:30 Eastern today, March 24th. Data will reveal whether the tourist exit is complete or still in progress. When the tourists finish leaving, that is when structural buyers historically re-enter at scale. Watch China's monthly silver ingot import data. If March follows February's multi-year high, China's accumulation is no longer anecdotal. It becomes a documented, primary source confirmed trend. Watch the IEA's next monthly oil market report. If the 10 million barrel per day curtailment estimate rises, the supply shock is worse than currently priced. And the dollar strength mechanism suppressing silver may hit a ceiling as oil destroys enough global demand to soften the growth premium. The dollar needs to hold its current level. $580 million positioned before Trump's announcement. China importing silver at multi-year highs during the crash. Industrial demand drawing from shrinking stocks with 0 price sensitivity. 67 million ounce projected annual deficit while mining costs rise fastest in years. The anomaly is not mysterious. It is the documented, primary source confirmed gap between what the paper market prices in real time and what the physical market is doing in real time. In 2008, that gap resolved toward physical reality. In 2011, toward physical reality. In 2020, toward physical reality. The mechanism that produces the anomaly is identified. The resolution depends on which force runs out of runway first. The paper market's dollar strength headwind, or the physical market's accumulation at the discounted paper price. This is financial intelligence, not advice. Verify every primary source before you act. And if this analysis gave you an edge today, like this video, share it with one person who needs to see it, and I'll see you in the next one.